Debit spreads and credit spreads are very similar in that they both have a defined risk and reward, but they need to be used in completely different contexts. So in today's video, I'm going to show you how you can choose between these two strategies. There's a million and one ways to choose between these two strategies, and we're only going to cover a few of these in this video, but the first and the easiest way to choose between a debit spread and a credit spread is by starting by choosing your strike prices. And whenever it comes to the strike price of a spread option, you want to make sure that the strike prices are out of the money. Now, out of the money is different for calls and puts. A call option is out of the money whenever the strike price is above the current market value of the stock. And a put is out of the money whenever the strike price is below the current market value of the stock. So now that we know which options are out of the money, we can choose between a debit spread and a credit spread. And the reason why we want to choose these out of the money strike prices is because of what's known as early assignment risk. Early assignment is whenever the options buyer that bought the option that you sold decides to exercise their end of the option early, because as a buyer for that option, once that option becomes in the money, they have the right to exercise that option in order to buy 100 shares if they're buying a call option, or sell 100 shares if they're buying a put option. And this means for you as a person that sold that option, you're going to need to buy or sell 100 shares of the stock to the buyer that exercise this call or this put option. But early assignment isn't as big of a deal as I'm making it out to be right now, because since you're buying an option and you're selling an option whenever you create a spread, this means that you can exercise the option that you bought, which will balance out the option that you sold getting assigned to you early. So this means that you'll be both buying and selling 100 shares of a stock that you're trading on. And since you're buying and selling the same 100 shares of a stock, your broker is going to take care of this for you to where you don't need the cash in order to make this trade happen. So early assignment is very easy to balance out and fix, but the problem is whenever you get assigned early, that bars you from trading for the rest of the day.
No more Fortnite!
Because your account is going to be placed in a deficit, and that deficit isn't going to be resolved until the option that you decide to exercise that you bought is finalized. And that doesn't happen until midnight on the day that you decide to exercise the option. So this means if you get assigned early on a spread, you're going to be barred from trading for the rest of the day. So this is why we want to choose out of the money strike prices. That way we can avoid this happening to us and we can trade freely. So choosing out of the money strike prices is the first way that you want to choose whether you're doing a credit spread or debit spread. So if you're assuming that the stock is going to come down, then you're going to do a put debit spread. But if you're assuming that a stock is going to either trade flat or come down, then you would open a call credit spread. And this is a second way to choose between a debit spread and a credit spread based on the sentiment that you have for the stock. So if you're bullish on a stock, you could either do a put credit spread or you could do a call debit spread, but it really depends on how much you think the stock will go up. So whenever it comes to bullish trades, if you're very bullish on the trade and you expect it to go above a certain price, and right now it's trading below that price, then you're going to want to use a call debit spread. But if you're assuming that the stock will at least trade flat or go up, then you're going to choose a put credit spread. So that is a bullish / neutral rating. Whereas if you're expecting the stock to go up above a price that it's currently trading below, then that is a bullish sentiment that you're setting for that stock. And then if you're bearish on the stock, expecting it to come below a strike price that it's currently trading above, then that is a bearish assumption and you would use a put debit spread. And finally, if you're expecting the stock to not go up, trade flat, and possibly come down, then you're bearish to neutral with that strategy and you should be using a call credit spread. I've actually made my spreadsheet to where I'm actually inputting the sentiment that I have for a stock. That way I can see which strategies and which sentiments are working best each month. And that'll give me an idea for what the sentiment was for that month. So we can choose between debit spreads and credit spreads by using sentiment, or we can decide by choosing our strike prices and making sure they're out of the money. And the last way to choose between these two strategies is using volatility. So volatility is just how much a stock moves on a daily basis. And a good gauge of volatility is the VIX index. So the VIX is the volatility of the S&P 500, or a measure of the volatility of the S&P 500. And whenever volatility is high relatively, then it's best to be using debit spreads because there is more opportunity, more money to be made, and a better risk-reward ratio whenever volatility is high, as long as you're guessing the direction correctly. Obviously, if you're guessing the direction wrong, this is where the risk-reward ratio can kind of help you out to where you can take on less risk on a debit spread whenever volatility is high. But whenever volatility is low, kind of like we're experiencing right now, then debit spreads no longer make sense because that opportunity and the risk-reward ratio just isn't as good as it used to be whenever volatility is high. So we can go by the VIX to find the volatility of the stock market, and whenever VIX is above 25, then it's best to be using debit spreads to take advantage of the high volatility. But whenever VIX is below 25, it's relatively low, and it's best to be using credit spreads. And this kind of ties in with the sentiment that we were talking about earlier, because whenever volatility is low, it's more likely that a stock is going to be trading flat than it is to be going up and down wildly, like when volatility is high. And you can use the volatility in the VIX and what's known as a rule of 16 in order to choose your strike prices whenever you're trading these spread options. So the rule of 16 states that the S&P 500 should only move by whatever the VIX is trading at, the number that it's trading at, divided by 16 once every 3 days based on one standard deviation. So this means if VIX is trading at 24, we divide 24 by 16, we get 1.5%. So if SPY goes up 1.5% one day and then up 1.4% the next day, then statistics tell us that it shouldn't go up more than 1.5%. So we can use this to make a call credit spread, assuming that SPY won't go up by that 1.5% mark. And then if VIX is above 25, again, we're going to use debit spreads to take advantage of the volatility. And whenever VIX is below 25, it's best to be using credit spreads because it's more likely that the stock market is going to continue trading flat. And those are the 3 ways to choose between these two strategies. Hopefully this video was helpful. Thanks for making it all the way to the end of this video, and thank you to all my patrons for their support. And as always, remember to stay positive, stay green. I'll catch you in the next one. Bye, guys.